My name is Garth Mackenzie, and I'm a technical analyst and an ETF strategist with Traders Corner. On today's show, I'm going to discuss the S&P 500 and the possibility that we're seeing a bear market rally at the moment. There's a lot of discussion around this, so I want to unpack it a little bit more and then have a look at what we can expect from the market in the next couple of months. And I'm going to start by taking a look at the previous two bear markets that we came through in 2003 and then again in 2008. So the first chart today takes a look at the bear market that we saw in 2000 to 2003. And what you can see there is that the market began to roll over in late 2000. Your 50-day moving average began to cross down below the 200-day moving average. That gives you a death cross, and we'll talk more about that in a moment. But what I really want to focus in on here is the bear market rallies that we saw during that bear market. You can see that that bear market unfolded over a period of about 2 years, and there's a steady pattern of lower lows and lower highs. And you'll notice how the 50-day moving average there continued to provide resistance on the downside. But also what you'll notice there is that there were some very big rallies during that bear market. You'll notice there were a couple of rallies in excess of 20%. So what I'm saying here is that in a bear market, you can actually get some very violent rallies to the upside. And that's what we need to be careful of. But those are also nice shorting opportunities if you're looking to try and play the market on the short side and look for a continuation in the bear market. Now, the next chart takes a look at the S&P 500 in 2008 and the crash that happened around the financial crisis then. And once again, you can see the market fell very hard, but there were a couple of very, very powerful bear market rallies that we saw there. One was 22%, one was 17%, and one was 26%. And these all happened over a relatively short space of time. So very similar to what we've just seen now on the S&P 500. So if we bring it back to the current chart of the S&P 500 now, this crash that we're seeing in 2020, you can see that we've seen the market fall very rapidly. This was the most rapid descent ever in a market crash. But also notice that we're now 20% up off the recent lows. So this has all the hallmarks of a classic bear market rally. You'll also notice there that yesterday, the 50-day moving average has now begun to cross down below the 200-day moving average. That gives you a death cross. And there's a lot of skepticism about that signal and whether it's reliable or not. I don't personally use it as a trade signal, but what I do use it for is a guide in terms of market direction and market momentum. And when your 50-day moving average is below the 200-day moving average, generally that is an indication of a weak market environment where the momentum is rather to the downside. What I'll be looking for here is a potential push up towards the 50% retracement of this recent decline. That comes in at just below 2,800, and maybe at a stretch we get a 61.8% retracement, and that would come in at around about 2,934. I think that would really be a stretch to get up there. But if the market starts to head up into that area, then I would possibly look for a reversal to start getting short on the S&P 500. Now, my last chart takes a look at an hourly chart of the S&P 500. And the reason I bring this up is because it's useful to look at this, to zoom in on the shorter time frame, to look for your entry signals if you are wanting to short the market. What we need to be careful of here is getting short too early. So what I use is a 15-period exponential moving average on the hourly chart, and you can see that quite clearly indicated in blue on this chart. What I'll be watching for here is for the market to start trading down below that 15-period exponential moving average, and for that exponential moving average to start pointing to the downside. If we start seeing that and we start seeing the market beginning to trade below that 15 exponential moving average, then I think it's an indication that the sellers are taking control. Up until then, you've got to be careful of just blindly shorting this market and thinking it's going to go lower. Often these bear market rallies can go higher than you think. So just take that into consideration and rather wait for the market to actually break down below that 15-period exponential moving average before going short. That's all I've got for you on this episode. I'll be back again with you later in the week with a look at the S&P 500 again and some ETFs that you can look to potentially trade for a pullback.